All right, let's talk about something really important in the trading world. We're going to get right to the heart of why so many people who try trading end up failing. But more than that, we're going to lay out a clear path so you can actually start off the right way. So, yeah, let's just dive right in. You've probably heard that statistic, right? That over 90% of new traders lose their money. It's honestly terrifying. You know, you see the potential, you're ready to put in the work, but this massive fear of failure is just awful, always there. So, what gives? Why is it so hard? Well, I'll tell you this. The answer is probably not what you're thinking. It's got nothing to do with how smart you are or some magical secret indicator. It's all about understanding the game you're actually playing. Okay, so check this out. This right here, this is the core reason most beginners get it wrong. Take a look at this chart. The retail traders, people like you and me, were that tiny little 5% slice. The other 95%, whoa, that's the big money. We're talking major banks and huge financial institutions. They're not just playing in the market, they are the market. They're the ones making the price move, period. So let's break this down. Why most traders lose. And really, it all boils down to a fundamental mistake. See, most people jump in thinking their little buy or sell order actually makes a difference. They think it's a battle against other small traders. Nope, not even close. You're trying to paddle a canoe against a tidal wave you don't even know is there. Okay, so let's get this crystal clear. Your $1,000 trade, it doesn't move the market not one bit. But $1 billion order from a giant bank, oh yeah, that definitely moves the market. The price goes up or down for one simple reason, a huge, massive imbalance between buying and selling. And guess where those massive orders come from? Yep, the big guys, the banks and financial institutions. If you try to trade without getting this, it's like trying to sail across the ocean without having a clue about currents. You're just going to get pushed around. All right, section 2. Follow the giant's footprints. Now, this is where it gets good because here's the thing. If we can't fight them, we can join them. The whole strategy we're about to lay out is built on one simple, powerful idea. Stop trying to predict where the market is going to go and start learning to see where the giants have already been. We're going to learn how to spot their footprints, see where they're placing their huge bets, and just, well, tag along for the ride. And this quote, this really sums up the whole philosophy here. I'm going to give you a fishing rod, not a fish. Look, anyone can give you a hot tip for a trade that might work out for a day, but what happens tomorrow, it's useless in the long run. What we're doing here is handing you the fishing rod. It's about teaching you the actual skill, the process, so that you can read the market for yourself, so you can become totally self-sufficient and find your own opportunities, not just today, but for years to come. All right, section 3, the market's map. So the big question is, how do we actually do this? How do we find these footprints? Well, that chart you're looking at, it's not just a bunch of random lines going up and down, it's a map. And on this map, the big players leave behind some very, very clear clues about where they made their big moves. We call these spots demand and supply zones. Okay, let's kick things off with demand zones. The easiest way to think about a demand zone is like a springboard or a trampoline for the price. It's a spot on the chart where the big banks came in and bought up everything in sight so aggressively that they actually left behind a bunch of unfilled buy orders. It's like they wanted to buy more but couldn't. So when the price comes back down to that exact area, those leftover orders can kick in and boom, the price tends to bounce right back up. And that right there is where we want to be looking to buy. And this is what it actually looks like. It's a really simple pattern you're training your eyes to find. See that little base area, that little chunk of sideways price movement? That's where the giants were placing their huge orders. And then bam, it's followed by that massive, powerful upward explosion. We call that the impulse. That little base is the footprint they left behind. So what's our job? Our job is just to be patient. We wait for the price to come back to that starting point, and only then do we even think about buying. Now, what about a supply zone? Well, it's the exact opposite. If a demand zone is a trampoline, a supply zone is like a brick wall, a ceiling. This is an area where the institutions were selling like crazy, leaving behind a bunch of unfilled sell orders. So when the price eventually climbs back up to that level, Then those leftover sell orders are waiting. They can soak up all the buying and slam the price right back down. Naturally, this is where we're looking for a chance to sell. And here's what it looks like on the chart. It's literally the same pattern, just flipped on its head. You see that small base where all the heavy selling was happening, and then whoosh, that sharp, powerful downward impulse. That base right there, that's our supply zone. And the game plan is exactly the same, just in reverse. We wait. We let the price come back to that origin point before we even consider hitting the sell button. Okay, let's put them side by side so it really clicks. On the left, you've got the starting point of a huge move up. That's your buy zone, your demand. On the right, you've got the origin of a big drop. That's your sell zone, your supply. See, it's the same simple recipe every single time. You find the base, you see the impulse. This right here, this is the pattern you need to burn into your brain. All right, section 4, the rules of survival. Now listen up because this is huge. Knowing how to find these zones is great, but it's only half the story. You could be the best chart reader in the world and still go broke if you don't have rock-solid rules to protect your money. I know this isn't the sexy part of trading, but trust me, this is what keeps you in the game long enough to actually succeed. And here it is, the single most important rule in all of 1%. That's it. You never ever risk more than 1% of your entire account on one trade. So if you've got $1,000 in your account, the most you can possibly lose on any single idea is $10. That's it. End of story. This rule all by itself will save your skin more times than you can count. Okay. Rule number 2 for survival is all about your risk to reward ratio. It sounds complicated, but it's not. It just means that for every $1 you're willing to risk, you should be aiming to make at least $1.50 back. By doing this, you're building a mathematical edge in your favor. Think about it. This means you don't even have to be right most of the time to make money. You could literally lose on 40% of your trades and still come out profitable. That's a game changer. So let's recap. You've got the strategy to follow the giants. You've got the risk rules to protect yourself. You're good to go, right? Well, not quite. Because now we have to talk about your greatest opponent, Section 5. You, the hardest battle you will ever fight in the market, isn't against other traders. It's against your own mind, your emotions, fear and greed. They are not your friends here, and they will try to sabotage you. And it pretty much boils down to these two accounts, fear and greed. Fear is that little voice that tells you to close a winning trade way too early because you're terrified it'll turn against you. Fear is also what causes FOMO, that awful feeling that you're missing out, which tricks you into chasing bad trades. And then there's greed. Greed is what tells you to double down and risk way too much after you've had a nice win. It's also what convinces you to invent trades that just aren't there just because you feel like you should be doing something. Both of them are absolute poison for your account. Seriously, take a second and let this one sink in. The market doesn't destroy you, you destroy yourself. You should probably write that down because the market, it's just numbers on a screen. It's totally impersonal. It has no idea who you are, and it doesn't care. Every single bad decision, every time you break a rule, that comes from you. That's why at the end of the day, trading is a game of pure self-discipline, and the absolute fastest way to blow up your account, it's a little thing called revenge trading. You know what I'm talking about. You take a loss, it stings, you get angry or frustrated, and you immediately dive back in to try and make it back. Block 6, that is pure raw emotion talking, and it is the ultimate account killer. So here is the rule to stop it. And this is non-negotiable. After you take 2 losses in one day, you're done. You stop, period. You close the laptop, you walk away. The market's going to be right there waiting for you tomorrow. Okay, I know that was a ton of information, so you might be thinking, great, but how do I actually do all this? That's where Section 6 comes in. Your 90-day action plan. We're going to break it all down into simple, manageable steps, giving you an exact roadmap for the next 3 months to turn all this theory into a real practical skill. So here is your roadmap for the first 90 days. It's 3 simple phases. Phase 1, the first 30 days. You're in a demo account and your only job is to master the process we just talked about. Get the reps in phase 2 days, 31 to 60. Now you can move to a small live account, and I mean small. The goal here is not to get rich. The goal is to feel the pressure of real money and learn to control your emotions. Then in phase 3, the last 30 days, you stop and evaluate. Are you being consistent? Are you actually following your rules? Only after you can honestly say yes do you even begin to think about adding more size. And to make sure you stay disciplined, you need a tool. This is your pre-trade checklist. Think of it like a pilot's checklist before takeoff. It's professional and you use it every single time. Is the economic calendar clear of any big news? Is the zone you found actually valid according to the rules? Have you gotten a clear confirmation to enter? Is your risk calculated to exactly 1%? No more. And just as important, are you in a calm, neutral state of mind? If you cannot check off every single one of these boxes, then decision is made for you. You do not take the trade. It's as simple as that. So let's leave you with this final thought. True success in trading isn't about hitting one big score or having a good month. That's just luck. Real success. It's about becoming the kind of person who can make money consistently. It's about building yourself into someone who is disciplined, who follows a process without question, and who can master their own emotions. Once you become that person honestly, the money just becomes a natural result of who you are. The real question isn't can you make money? It's are you willing to do the work to become that person?